Welcome to this explainer, everyone. Today, we're taking a magnifying glass to the architecture of wealth. Look, we all interact with money every single day, right? We earn it, we definitely spend it, and we try our best to save it. But how much do we actually understand the system our money lives in? Well, we're going to take a deep dive into the inner workings of banks, the strategies of billionaires, and most importantly, how every bit of this directly impacts you. Let's kick things off by challenging a huge assumption. I think most of us picture our checking accounts as these impenetrable digital vaults. We deposit our paychecks, check the balance on our phones, and just kind of assume our money is sitting there safely, waiting for us to buy groceries or pay rent. But the reality? It's far more interesting. Your money isn't resting at all. It's actively being used as a business asset every single day, generating profits for someone else. So to really understand how wealth is built, we've got to pull back the curtain on the institutions holding our paychecks.
All right, Section 1, the hidden financial system, shattering the illusion.
Let's talk about fractional reserve banking. When you drop 5 grand into your account, it doesn't just hang out there. Nope. The bank immediately puts most of it to work by lending it out to other people. They literally only keep a tiny fraction of total deposits available for withdrawals at any given time. The whole shebang functions smoothly simply because not everyone withdraws their money at the exact same moment. It's honestly a brilliant system built entirely on public confidence and trust, and it allows banks to stimulate economic growth by constantly moving capital around.
Moving right along to Section 2, how banks make money, the playbook.
So your money is constantly on the move. And that brings us to a massive, eye-watering number: 25%. That's the towering APR a bank might slap on someone who's carrying credit card debt. Banks know perfectly well that human psychology makes people spend more when they're using credit. And when that balance isn't paid in full, wow, that interest stacks up fast. We're talking incredible recurring revenue for the institution month after month after month. But then, in stark, almost funny contrast, you've got this measly 0.5%. That's what the bank might pay you for keeping your hard-earned savings with them. You're the one providing the capital, but you're only seeing a tiny, microscopic fraction of the return. So the absolutely crucial point here is the difference between those two numbers. It's called the interest spread, and it's one of the oldest, most powerful profit engines in history. Banks act as these giant middlemen between savers and borrowers. They pay you 0.5%, they charge the next guy 25%, and they happily pocket the difference. And when you apply that difference across the trillions of dollars managed by major financial institutions, it generates unbelievable continuous profits. But listen, banks absolutely don't stop at just loans. They operate like giant financial supermarkets, feeding off practically every corner of your financial life. Swipe for a coffee, they collect interchange fees. Account drops below zero by mistake, boom, $35 overdraft fee. They rake in hundreds of thousands of dollars in interest on 30-year mortgages, quietly skim management fees off your retirement accounts, and they even use your vast consumer data to precisely market new, highly profitable products right back to you. As long as you stay inside the cycle of borrowing, spending, and paying fees, you're their perfect customer. Which leads us to Section 3, the wealthy ownership advantage, beyond the paycheck. Let's see how all of this builds into the stark reality between everyday earners and billionaires. You know, a lot of people assume the wealthy simply work harder, but actually, the system heavily rewards those who own assets over time. Think about it. A labor mindset means trading your hours for a salary, which, by the way, gets taxed immediately before it even hits your bank account. But an ownership mindset, that focuses on acquiring assets like businesses, real estate, and stocks that grow while you're literally sleeping. The tax code actively rewards this investment behavior, allowing owners to legally defer taxes and leverage all kinds of deductions. Here it is, the ultimate wealth loop used by the ultra-rich. Step 1, acquire assets. Step 2, let those assets appreciate in value over time. Now, instead of selling stock to get cash, which would trigger massive capital gains taxes, we hit Step 3. They borrow against their asset portfolios at incredibly low interest rates. Finally, Step 4, they use that tax-free borrowed cash to fund their lifestyle or go out and buy even more assets. It's a completely endless cycle of wealth creation that entirely bypasses traditional wage income.
Now for Section 4, compounding and systemic leverage, the growth engine.
As we peel back the layers of this strategy, we hit the true accelerator of the billionaire playbook. Compound interest is the eighth wonder of the world. Now, whether Einstein actually said this, actually scratch that. It doesn't even matter who said it. The principle is incredibly true when applied to extreme wealth. Billionaires don't just earn money. Their money earns money. And then that new money goes to work and earns even more money. Over decades, compounding creates almost unbelievable results, turning modest annual returns into enormous increases in net worth, simply because the starting numbers are so large. Consider the breakdown of billionaire wealth. 45% comes from business equity, 35% from stocks, 19% from real estate, and wage income? It makes up a microscopic 1%. Every single time millions of us buy a coffee, renew a streaming subscription, or upgrade a smartphone, the owners of those companies see their equity climb. They're scaling their wealth globally and almost entirely ignoring a traditional salary. And man, this systemic leverage becomes painfully obvious during economic downturns. While central bank policies and rising inflation are just squeezing the life out of the average earner's buying power, asset prices often just keep climbing. While an average earner might be forced to sell off their investments just to survive a crisis, the wealthy, they use their immense liquidity and time to buy up discounted assets. Crises that totally devastate average households frequently turn into incredible wealth-building opportunities for the ultra-rich, which just widens that wealth gap even further.
Okay, Section 5, Changing Your Financial Mindset. Tools, not traps. So, how do we actually navigate this? Because the issue isn't really the banks make money or the businesses scale. The real issue is that so many of us are playing the game without actually knowing the rules. People who truly understand money avoid unnecessary interest, they negotiate terms, and they use banks as tools, not traps. They make a fundamental paradigm shift. Instead of constantly asking, how can I earn more, and just focusing on income, they start asking, how can I own more, and they focus on equity. They completely transition their mindset from merely earning a paycheck to acquiring long-term assets that generate cash flow and appreciate over time.
Once you realize how the architecture of wealth is actually built, how banks leverage your deposits, how interest spreads fuel these financial supermarkets, and how the wealthy use ownership and compounding to their advantage, the whole illusion just disappears, right? You finally know the rules of the game. So, the only question left for us to ask ourselves is this: are you going to remain the perfect, profitable customer, or will you start making the system work for you? What are you going to do with your next dollar?